Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, August the 23rd. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Anyway, having that out of the way, let's get this on. Sorry about the background noise. We're getting some rain here and it's hitting the skylight, so we could have some background noise going through this. Anyway, we've got quite a bit of economic data coming out today in the form of PMI, and that's the Purchasing Managers Index. One of the most important ones for me to look at because it's more forward-looking. It is the managers of different manufacturing companies and what they are looking forward to buying, how they are anticipating demand to be, and that's going to influence what they are purchasing to be inputs into the manufacturing process. Anyway, so in that number, anything above 50 is expansion in that market, and anything below 50 is contraction. And with the French manufacturing PMI, we got a 48.5, which was lower than expected, 49.1, so it is below that 50 threshold. Then we also got the services PMI, came in a little bit better than what they were expecting at 52.0, expected 50.6. German manufacturing PMI came in at 53.6, right in line with expectation. Their services PMI came in slightly below expectations at 53.6. Then we also got the overall the United States manufacturing PMI came in lower than expected at 52.1, expected 53.1, and Richmond Fed manufacturing index really came off quite a bit. Was expected a 6, came in at negative 11. Last month it was a 10, which beat expectations, but really came off this week. Then we also got existing home sales, or new home sales, came in bangbusters at 654,000 units versus the 574,000 units, so a lot better than expected on that front. So that was a huge beat. Overall, equity markets are pushing higher despite that Richmond Fed number and the PMI here in the United States. But crude oil pushing higher, up 1% on the day, up about 50 cents. The reason why that is because Iran came out today and basically said that they would possibly cut production in order to increase prices of oil, but that is just a rumor, and that's what was crude oil was grabbing a hold of and really popped higher on that. Iraq, on the other hand, basically came out and said that they kind of saw it going to 35 possibly. So we will have to see what is going on with those numbers right there. But everybody grabbing on to what Iran was talking about on possibly cutting production. But, I'm fading that for the record. Anyway, on to gold futures right now, /GC, down 20 cents on the day. But, like we keep talking about, stuck right in this trending sideways market. Bonds just off a little bit, down 2 points on the day. Really just kind of taking a breather after yesterday's big rally. Then on to the NASDAQ, making new highs today. S&P's made new highs today, and these are all-time highs. There's a lot of complacency in the market. Volatility is at extreme lows. We could see, actually, I'm starting to wonder if we're going to see a bit of a short squeeze going on here as the overall market is so complacent. A lot of big money probably starting to fade this as I've been fading it, but I am getting a little bit nervous about a possible short squeeze and possible pop to the upside. I am long S&P calls in there, but that's as a hedge for my overall portfolio, but we'll have to see how that works out. Then the S&Ps right here, as you can see, the E-mini S&Ps /ES up 6 points on the day, again making a new high, 2191 and a half. So that was made right off of some of that news about Iran possibly cutting production there. But since then, euphoria has come off. But as you can see, overnight, we just kind of really spiked higher. And that was off of some of that PMI data points that we were getting overnight. And then on that Iran news causing crude to come off its lows and really just skyrocket, really pop fast. The equities followed suit with that. Now, on to a couple of things I done. Now, Target, I forgot to mention this yesterday with the daily market commentary, but I allowed myself to get put this stock at $72. If you remember, on an earnings strangle, what I did was I went in there and I had originally put on the what was it, the 72.83 and a half, I believe, strangle. It was 70. It was the 72.78 and a half strangle I put on there for the earnings trade, and on earnings we got a down swoosh on that, and I just let myself get put those stock. So now I'm long Target at 72, so I'm underwater on that. But if you remember, I did that 78 and a half strangle. I originally collected 83 cents for it. So now that I'm long this stock, I'm going to cover it with some calls. And I sold the September 72 and a half calls for 64 cents. So that's lowering my basis on that overall trade. And if it gets up to 72 and a half, I'll be happy to have that stock called away from me, because I would make 50 cents to the upside on the 72s that I'm long, and the overall 83 cents that are originally sold that strangle for will help out as well. So even if it goes above 72 and a half, I'll still be able to slightly take advantage of some of that upside momentum, because with the 72s that I'm long, that's a 100 delta, and with the September 72 and a half calls that I'm short, that's about a 30 delta. So I'll be able to participate on about 70, maybe even 50 cents if it gets to that point for every dollar it increases. So that's what I'm looking for that trade there. And then I moved on to HES brands, which I'm just looking to do a couple of things. HES just looks like it's taking a breather here and could continue to trade to the upside. So I did the October and bought the 50 calls, sold the 62 and a half calls to help finance some of that extrinsic value, and paid $6.30 for that trade. So that's going to be a good one to for Friday's webinar. We're going to be doing it on long call spreads, and then the next week we're going to be doing it on long put spreads. So setting up some of these for that particular webinar as well. And in Visa, I'm going into the September and did the bought the 83 puts and then sold the 78 and a half puts to create that long put spread, and paid $1.83 for that strategy. So the reason why I'm putting on a bearish call for Visa is if the Fed is not going to raise rates anytime soon, then Visa will be hurt on their margins for the tighter margins. As interest rates increase, they're going to be able to make more money on interest. As interest rates stay suppressed, then that really bites into their margins there. So that's why I'm putting that on. I think the Visa started rallying on the expectation that the Fed was going to start raising rates, but as we can see, with the Fed speak that's been going on, that there's probably not going to be a Fed hike anytime in 2016. All right. So go to protraderstrategies.com, sign up for that webinar on Friday. It's a really good one, especially in this low implied volatility environment. It's a perfect trade for this type of scenario, especially if you have a market assumption. All right, that's all I got for you guys today. If you can't take that, take it easy.